So today we are going to discuss about underwriting of shares and debentures. What is underwriting? Underwriting is a contract between a company and underwriters. They may be an individual or an institution ready to take up the whole portion of issue of shares or partial portion of issue of shares, those which are not subscribed by the general public, considering as consideration of underwriting commission. So underwriting is defined as a contract entered into by a company with persons or institution called underwriters, who underwriting to take up the whole or portion of such of the offered shares or debentures as may not be subscribed by the public in consideration of remuneration called underwriting commissions. Underwriters. Who are underwriters? Who are underwriters? Those persons who are involving, who are guaranteeing or agree to take up shares or debentures of a company is known as underwriters. Uh, Sub underwriters. If the underwriter is again underwriting to someone, underwriters is called as sub agreement. Those underwriters are known as sub underwriters. These underwriters get small amount of commission for this such kind of underwriting. Need for an underwriting. So basically, underwriter is mandatorily required to meet out the subscription done by SEBI. 90% of subscription is mandatory for an issue. For meet out this subscription, the company is mandatorily required to underwrite its shares. Then to overcome the risk of subscription, then to overcome the risk of right issue. Advantages of underwriting. Advantages of underwriting. So underwritings are guaranteed against a danger or risk of an undersubscription. It provides assurance to the company in definite receipt of a stipulated amount from public issue. It enables the company to go ahead through their financial requirements to meet out the investment programs. It also enables a smooth functioning of the company in capital market. So advantages of underwriting. So underwriters takes advantages of sub underwriting. The sub underwriting transfers the risk between both the underwriters. It's helped the transferring risk of its underwriting commission. So generally the underwriting commissions may not be exceed above 5% from the issue price of shares or debentures. So the maximum commission for shares is 5% and the commission for debenture is 2.5%, which the commission must not be exceeded at this rate. Types of underwriting. Types of underwriting. So underwriting is generally classified in 3 types: full underwriting, partial underwriting, and firm underwriting. The entire issue of shares will be underwritten with underwriter is called full underwriting. Partial underwriting is somewhat a portion of amount, a portion of shares, or a partial issue of shares are underwritten is known as partial underwriting. Firm underwriting is the underwriter must buy a defined number of shares or debentures in addition to the issue of shares underwritten by them. Again, we have some types: marked applications, marked application and unmarked application. Marked applications are the application which have any marking or stamping of an underwriter is known as marked application. Unmarked applications doesn't have any mark or symbol or anything in the application is known as unmarked underwriting. So accounting treatments for underwriting. So for the first transaction for underwriting is the receipt of application money and the allotment of applications. After this allotment, the underwriters may eligible for underwriting commission. For this, the journal entry for underwriting commission is payable to underwriters is underwriting commission account debtor to underwriters account. For receipt of balances, after the allotment as well as and after underwriting commission payable, there is a amount payable by the underwriter or by the company is to be find out. After finding, if the company want to settle the balance means underwriters account data to bank account, or underwriters have to pay to company means bank account data to underwriters account. Thank you.